Hey there, folks. Welcome to our deep dive into the fascinating world of dividend income. Are you tired of the daily grind, feeling like you're stuck in a never-ending cycle of work, bills, and more work? Want to make your money work for you instead of the other way around? Imagine a scenario where your investments generate income while you sleep. Then listen up, because we're diving into the world of dividend investing. This strategy isn't just for the wealthy. It's accessible to anyone willing to learn and invest wisely. Imagine this: money flowing into your account every single month. That's right, consistent, reliable income that you can count on. That's the beauty of dividends. They provide a steady stream of income which can be reinvested to compound your wealth over time. Companies share their profits with you, the investor. It's their way of saying thank you for your trust and investment. It's like getting a paycheck just for owning a piece of their business. Sweet, right? And the best part is you don't have to do any extra work to earn it. Now, I'm not saying it's a get-rich-quick scheme. Dividend investing requires patience and a long-term perspective. It takes time and patience, but building a solid dividend portfolio can provide a steady stream of passive income. Over time, this can grow into a significant source of financial security. Whether you're saving for retirement, a dream vacation, or just some extra spending money, dividends can help you get there. They offer flexibility and financial freedom. So buckle up, because we're about to break down everything you need to know. From choosing the right stocks to understanding dividend yields, we've got you covered. Let's get started on this exciting journey to financial independence. All right, let's talk numbers. Numbers are the backbone of any investment strategy, and understanding them can make the difference between a successful portfolio and a disappointing one. Dividend yield is your magic number. It's a crucial metric that helps investors gauge the profitability of their investments in terms of the income they generate. It tells you how much income you can expect to receive from a stock relative to its price. Essentially, it's a way to measure the cash flow you're getting for each dollar invested in an equity. Think of it like this: it's the rent you collect on a property. Just as a landlord expects a certain amount of rent from tenants, investors expect dividends from their stock holdings. You want a good return on your investment, right? A solid dividend yield can be a sign of a healthy income-generating stock, which is exactly what you're aiming for. To calculate dividend yield, divide the annual dividend payment by the current stock price. This simple formula can provide a quick snapshot of the income potential of a stock. For example, if a stock pays $2 in annual dividends and trades at $50 per share, the dividend yield is 4%. $2 divided by $50 equals 0.04 or 4%. This means for every dollar you invest, you get 4 cents back in dividends annually. Simple, right? This straightforward calculation can help you compare different stocks and make more informed investment decisions. Remember, a higher yield might seem tempting. It can be alluring to go for stocks with the highest dividend yields, thinking they will provide the best returns. But don't just chase the highest number. High yields can sometimes be a red flag indicating potential issues with the company or unsustainable dividend payments. We'll explain why in a bit. Stay tuned to learn more about the nuances of dividend yields and how to use them to your advantage in building a robust investment portfolio. Now, here's the catch. Not all dividend yields are created equal. Some yields are too good to be true. They might be unsustainable in the long run. Think of it like a sugar rush. It's great for a little bit, but then you crash. A sustainable yield is like a balanced diet. It provides steady income without jeopardizing the company's financial health. Generally, a yield between 2% and 4% is considered a good balance between income and safety. Extremely high yields, above 4 to 5%, can be a red flag. It might mean the company is struggling. Always do your research, folks. Dividend growth is where things get really exciting. It's like getting a raise from your tenants. Companies that consistently increase their dividends are like gold mines. They show they're profitable and committed to rewarding shareholders. Over time, even small dividend increases can make a huge difference in your returns. Why? Because of the magic of compounding. When dividends are reinvested, they buy more shares, which generate more dividends. It's a beautiful cycle of growth. Section 5. Reinvesting dividends, compounding your wealth. Speaking of compounding, let's talk about reinvesting those dividends. This is where the real magic happens, folks. Think of it like a snowball effect. It starts small, but as it rolls down the hill, it gains more and more snow, becoming bigger and bigger. Reinvesting your dividends is like adding more snow to that snowball. It allows you to buy more shares, and more shares mean more dividends. Over time, this compounding effect can supercharge your returns and help you reach your financial goals faster. Don't underestimate the power of compounding. Section 6, Case Studies, SCHD and VOO. Let's look at some real-life examples. SCHD, which stands for Schwab US Dividend Equity ETF, and VO Vanguard S&P 500 ETF are two popular investment options. SCHD focuses on high-quality dividend stocks, while VEO tracks the S&P 500 index. SCHD has a higher dividend yield, meaning you need less capital to generate the same income as VEO. However, VO offers broader market exposure. The choice depends on your individual goals and risk tolerance. Remember, folks, these are just examples, not recommendations. Section 7. Achieving your monthly dividend goals. Now let's talk about how much capital you need to achieve specific monthly dividend goals. Dividends can be a reliable source of passive income, but the amount you need to invest can vary significantly based on your financial goals and the dividend yield of your investments. Let's say you want to generate $500 per month in dividend income. This is a common goal for many investors who are looking to supplement their monthly income without having to sell their investments. Now, if your goal is more ambitious, like generating $2,000 per month in dividend income, the required capital will be significantly higher. This level of income can provide a substantial boost to your financial stability, potentially covering major expenses like rent or mortgage payments, or even $5,000 per month in dividend income. Achieving this level of passive income can be transformative, allowing for greater financial freedom and the ability to pursue other interests or retire early. So, how much would you need to invest to reach these goals? The amount of capital required depends largely on the average dividend yield of your investments. Dividend yield is the annual dividend payment divided by the stock price, expressed as a percentage. Assuming a 3% average dividend yield, here's a rough estimate. This yield is a common benchmark for many dividend-paying stocks and can serve as a useful reference point for your calculations. To generate $500 per month, you would need to invest around $200,000. This might seem like a large sum, but with disciplined saving and investing, it can be achievable over time. For $2,000 per month, the required investment jumps to around $800,000. This level of investment might be suitable for those with higher income or substantial savings looking to create a significant passive income stream. And to achieve $5,000 per month, you would need to invest approximately $2 million. This is a substantial amount, often achievable for those who have been investing for many years or have accumulated significant wealth. Remember, these are just estimates. The actual amount you need can vary based on the specific stocks or funds you invest in, as well as market conditions. Market conditions can affect dividend yields and stock prices, which in turn can impact your dividend income. It's important to stay informed and adjust your strategy as needed. It's crucial to consult with a financial advisor to determine the right investment strategy for your individual circumstances. A professional can help you navigate the complexities of dividend investing and tailor a plan that aligns with your financial goals and risk tolerance. Section 8, conclusion: building long-term wealth. Dividend investing can be a powerful tool for generating passive income and building long-term wealth. By focusing on sustainable yields, dividend growth, and the power of compounding over time, you can create a portfolio that works hard for you. Remember, folks, it's a marathon, not a sprint. Be patient, stay informed, and don't be afraid to seek professional guidance when needed. With the right approach, you can achieve your financial dreams and enjoy the fruits of your labor for many years to come. Section 9, disclaimer. This essay is for educational purposes only and should not be considered financial advice. Investing involves risk, and past performance is not indicative of future results. Consult with a qualified financial advisor before making any investment decisions.